You're ambitious, driven, maybe even burning the midnight oil. But are you seeing the kind of financial progress that reflects your effort? What if there's a core financial education, a set of principles rigorously applied by the ultra-wealthy? That could be the missing piece in your wealth-building puzzle.
That's exactly what we're going to explore in this deep dive. The financial knowledge that billionaires prioritize and, well, how you can strategically adopt these powerful insights.
We know that you, the listener, are likely a professional striving for the top. Maybe a resourceful entrepreneur or a discerning investor.
Yeah, you're looking for more than just surface-level advice. You want actionable understanding, those key insights that can reshape your financial trajectory, delivered without, overwhelming you with unnecessary details.
Right.
This deep dive is tailored to provide you with that essential financial education.
And to bring you this focused perspective, we've examined a range of sources, from the inner workings of wealth management firms and the diverse investment strategies of sovereign wealth funds. These are essentially state-owned investment funds managing national savings, to in-depth academic research on wealth creation and the practical financial realities within various communities. We even uncovered some, pretty intriguing aspects of the culture surrounding significant wealth.
Our mission in this deep dive is clear: to distill the fundamental financial education principles that consistently guide those at the highest levels of wealth. We aim to translate these often opaque concepts into practical strategies that you can implement to build and sustain substantial wealth.
Okay, let's unpack the first crucial element. The truly wealthy operate with a mindset that extends far beyond simply earning a high income, right?
Absolutely. Their focus is on understanding the fundamental drivers of true wealth creation, which overwhelmingly come down to strategic investment and, critically, ownership.
We came across an interesting example, didn't we? About a client whose initial fortune was built through intense dedication to their family business.
Yes, that highlights that sometimes a concentrated effort in your specific area of expertise can be a powerful catalyst.
But it's not the only way.
No, definitely not. While a strong income provides the capital for wealth accumulation, it's the intelligent allocation of that capital into appreciating assets, along with owning businesses or significant equity positions, that fuels exponential growth.
Right.
The client story illustrates the potential of focused expertise, but it's also worth noting that as wealth scales, considering broader diversification to manage risk typically becomes essential for long-term sustainability.
Right.
What's fascinating here is the concept of wealth expertise, a deep-seated drive and skill set centered on wealth generation.
Like a specialized skill.
Kind of. It involves a keen understanding of financial markets, risk assessment, deal structuring, and long-term economic trends. And as research suggests, it can often be applied across different industries.
It's almost like a specific lens through which they view opportunities, isn't it?
Precisely.
Interestingly, this intense focus on wealth creation often isn't accompanied by outward displays of affluence. We encountered discussions about the culture within elite universities.
Oh yeah, where you'd expect flashiness.
Exactly. But reports suggest a prevailing culture of understatement, maybe even a sense of, shame, where full-paying students might downplay their financial background.
Interesting. So the focus isn't on showing off the money.
It seems not. It indicates that the primary focus, within those circles at least, isn't on showcasing wealth, but on its quiet accumulation and preservation.
That makes sense. The emphasis shifts from conspicuous consumption to the strategic deployment of capital, which connects directly to another key principle we observed: a relentless focus on return on investment.
The spend $1 to get 3 back idea.
Exactly. Or 5, or even 10 back. Successful entrepreneurs and business owners prioritize this. We saw tangible examples, like a rental property renovation that significantly increased its monthly cash flow.
Right, I remember that one.
Or advertising campaigns that generated 4 to 5 times the initial investment in revenue. This ROI-centric thinking drives a very deliberate evaluation of both expenditures and investments.
It really prompts you to examine your own spending, doesn't it? Like, are you assessing your outlays with that kind of potential return in mind?
Good question for everyone listening.
This naturally leads us to the crucial area of strategic investing. Diversification is a term we hear frequently, and our sources strongly support its importance as a mechanism to mitigate risk.
Absolutely. The fundamental idea is that by allocating capital across various asset classes, you can potentially achieve more stable growth because, underperformance in one area might be compensated by gains in another.
It's a cornerstone of prudent wealth management.
Definitely. However, the initial success of that client, heavily invested in their family business, reminds us that the timing of diversification is also a key consideration.
So it's not always diversify immediately.
Well, there can be phases where concentrated investments in high conviction areas yield substantial rewards. The critical insight is understanding when to leverage focused expertise and when to broaden exposure to reduce potential downsides.
Okay, got it.
In terms of specific strategies favored by the ultra-wealthy beyond broad asset classes, this can include allocations to alternative investments, things like private credit, which can offer higher yields than traditional bonds, or timberland, which can act as a hedge against inflation, or even fine art, though that requires specialized knowledge, of course.
Right.
The rationale behind these is often to find uncorrelated assets that offer unique risk-return profiles.
And for those ambitious investors seeking potentially higher growth, the technology sector frequently emerges in these discussions.
It does. Our sources indicate that while it can come with increased volatility, employing longer holding periods and practicing careful, selective investing can be strategies to navigate that risk. It's definitely not a passive approach.
Yeah. Not at all. Investing in growth sectors demands a more active and informed approach.
Yeah. And what's particularly noteworthy is that wealthy individuals often gain access to exclusive networks and platforms. These provide them with proprietary information, partnership opportunities, investment deals, stuff that might not be readily available to the general public.
A network effect.
Exactly. While traditionally private banking arms offering such access often had very high minimum investment requirements, sometimes around $10 million.
Wow.
There are now emerging platforms aiming to sort of democratize access to some of these tools, allowing a broader range of investors with shared goals to connect and potentially leverage collective insights for growth.
Thinking about significant global investors, we also looked into the strategies of sovereign wealth funds again. These are state-owned investment funds managing national savings. Their approaches offer some interesting insights.
What do we see there?
We observe their tendency towards geographical diversification, although they sometimes exhibit a home bias, favoring investments in their own country. And they consider factors like physical distance and cultural similarities in their investment decisions.
Analyzing SWF strategies reveals both sophisticated approaches and potential limitations. While they aim for long-term growth through equity investments and often diversify geographically, studies suggest their long-run performance in equity investments has sometimes been, well, less than stellar.
Really? Why is that?
It can be attributed to factors like imperfect diversification and challenges with corporate governance. It's a reminder that even the largest and most sophisticated investors aren't immune to challenges in implementing optimal investment strategies.
That's a good point.
We also noted their tendency to diversify into industries different from their home country's core sectors, which suggests a strategic effort to broaden their economic foundations.
Okay, this leads us to a really critical point for high net worth individuals. The significant impact of taxes on wealth accumulation.
Oh, absolutely.
We examine the differences between taxable and non-taxable investors, referencing research from Ibison Associates. The key takeaway: wealthy investors must be hyper-aware of after-tax returns.
Definitely. When you're operating in top income tax brackets, the after-tax calculus changes dramatically. For instance, municipal bonds, which are exempt from federal income tax and sometimes state and local taxes, they can offer more attractive after-tax returns compared to U.S. Treasury bonds for high net worth individuals. Beyond municipal bonds, sophisticated tax optimization strategies employed by the wealthy can include establishing tax-advantaged trusts or utilizing things like charitable remainder annuity trusts, which can help minimize estate and income taxes.
That's absolutely right. Ignoring the impact of taxes can significantly erode long-term wealth.
It really can. Implementing strategies to minimize tax liability is a fundamental aspect of sophisticated financial planning for the wealthy. This extends to carefully considering the tax implications of liquidating assets, whether for personal consumption or reinvestment, and planning accordingly.
Right. Planning ahead is key there.
Always.
Finally, on the investment front, it's crucial to touch on the importance of maintaining a grounded perspective and resisting the allure of new paradigm narratives that can inflate asset bubbles.
Yes. The hype cycles.
Exactly. History provides numerous examples, like the dot-com era, where overly optimistic forecasts proved to be wildly inaccurate, leading to significant losses for many.
It's a powerful reminder to maintain a healthy skepticism and a reliance on fundamental analysis, rather than getting caught up in speculative frenzies, no matter how compelling the story may sound.
That element of financial wisdom is essential for long-term success.
Definitely. A critical perspective and a grounding in historical precedents serve as vital safeguards against making costly mistakes driven by irrational exuberance.
Shifting our focus slightly, beyond just investment strategy, we see that the ultra-wealthy also prioritize fundamental financial literacy and meticulous planning. This begins with understanding something as basic as your credit score.
Foundational stuff, but so important.
Yeah. It was interesting to learn that while hard inquiries, which typically occur when you apply for new credit, can slightly lower your score, your income level surprisingly has no direct impact.
Right. It's fundamentally about how responsibly you manage the credit you have. Soft inquiries, on the other hand, like background checks, generally don't affect your score.
Good to know.
Foundational financial literacy is absolutely non-negotiable. Understanding credit, the principles of budgeting, the relationship between risk and reward in investing, these are essential building blocks for anyone looking to build wealth.
We came across a helpful 5-step framework, didn't we?
Yes, and while it seems basic, it's rigorously applied. 1, create a detailed budget. 2, establish a robust emergency fund, think 3 to 6 months of living expenses.
Crucial safety net.
Absolutely. 3, set clear and specific financial goals. 4, diversify investments strategically. And 5, regularly review and adjust your financial plan as circumstances change.
It's a systematic approach that anyone can adopt, really.
Pretty much, regardless of their current financial standing.
And when it comes to banking, even this seemingly straightforward decision can have implications. We explored the pros and cons of different types of banks, national, regional credit unions, online banks.
Right, noting the trade-offs between the range of services offered, the interest rates on savings and loans, and the perceived level of security and customer service.
It's about aligning your banking choices with your individual needs and overall financial strategy.
That's right. Understanding the diverse landscape of financial institutions empowers you to make informed choices that support your financial goals. What's particularly noteworthy when discussing the financial plans of the wealthy is the significant role that philanthropic intent often plays.
Giving back.
Yes. And planning for charitable giving early on, especially before a major liquidity event like selling a business or receiving a large inheritance, can offer substantial tax advantages.
Tax advantages, okay.
And it reflects a broader perspective on wealth and its impact. This often involves establishing private foundations or utilizing donor-advised funds to strategically manage their charitable giving.
Makes sense. Moving to a slightly different perspective, a core tenet of the wealthy's financial education seems to be adopting a long-term perspective coupled with resilience.
Definitely. They understand that building lasting wealth is not a sprint, but a marathon.
Long-term investing is often viewed as efficiently navigating from point A to point B, with the short-term market fluctuations being less critical to the core wealth creation process.
Right, except for the compounding, of course. The power of compounding returns over the long term is a fundamental principle they deeply understand and leverage.
That long-term mindset is absolutely crucial.
It allows for weathering inevitable market cycles and benefiting from those powerful compounding effects over decades. Another key aspect of their resilience is the proactive practice of stress testing their portfolios.
Stress testing, what does that involve?
It involves going beyond simply analyzing past volatility. It requires understanding potential downside risks based on current market valuations, economic indicators, and the underlying fundamentals of their businesses and investments.
So looking ahead at what could go wrong.
Exactly. And naturally, you can't discuss long-term financial planning without acknowledging the possibility of unforeseen events, the so-called black swan event.
Right, the big surprises, like 2008.
Precisely. Unpredictable events that can have a significant and unexpected impact on financial markets. Building a resilient portfolio that can withstand these unpredictable shocks is a significant priority for the ultra-wealthy.
We also observed a trend among wealthy families and institutions to increase their allocation to alternative investments, hedge funds, real estate, private equity.
Yeah, though it's important to note the often high fees and potential tax inefficiencies associated with some of those options require careful consideration.
True.
Private equity, particularly investments in early-stage businesses, can offer both high growth potential and certain tax efficiencies related to capital gains treatment, though.
So the increased allocation to alternatives reflects a strategic search for potentially higher returns and greater diversification beyond traditional publicly traded stocks and bonds.
Pretty much. But, as you pointed out, the complexities and costs associated with these investments necessitate expert guidance and a thorough understanding of their specific risks and potential benefits. You need to know what you're doing.
Definitely. Finally, we wanted to touch upon a broader perspective, moving beyond individual wealth accumulation to consider the interplay between wealth building and community and systemic factors.
Okay.
We explored the concept of community wealth building, where collective action and local institutions aim to exert greater control over economic development within their communities. This often involves exploring alternative ownership models like worker cooperatives and community land trusts.
This broader perspective recognizes that individual wealth accumulation occurs within a larger economic and social context, doesn't it?
It does.
Community wealth building initiatives aim to foster more equitable and resilient local economies by empowering residents and local institutions. It's also crucial to acknowledge the persistent racial and generational wealth gaps that exist,
Yeah, that came up quite a bit.
highlighting that systemic barriers continue to prevent certain demographic groups from accumulating wealth at the same rate as others. Factors like limited access to savings opportunities, the prevalence of harmful lending practices, and the burden of debt are significant indicators of financial hardship for many.
It's encouraging, though, to see ongoing efforts to create a more inclusive and equitable financial system.
Like what?
Well, the growth of fintech companies and the increasing availability of financial coaching offer potential pathways to broaden access to financial services and provide personalized guidance, particularly for historically underserved communities.
Right. Trying to level the playing field somewhat.
The fundamental idea is to design financial systems that work effectively for everyone, not just those who have historically benefited from privilege.
Huh.
We also briefly discussed the potential of employee ownership models as a mechanism to narrow wealth gaps.
Giving workers a direct stake.
Exactly. A stake in the success of the businesses they contribute to.
Ultimately, a more inclusive financial system benefits society as a whole. By addressing systemic inequalities and empowering individuals and communities financially, we can foster broader and more sustainable economic prosperity.
So to synthesize our discussion, building wealth like the ultra-wealthy isn't solely about achieving a certain income level.
No, definitely not.
It's fundamentally about embracing a specific and sophisticated kind of financial education, one that prioritizes strategic investment with a focus on ROI, a long-term vision that weathers market fluctuations, a deep understanding of risk and return, meticulous and ongoing planning that includes tax optimization and philanthropic considerations, and a proactive, ownership-oriented mindset.
That sums it up well. As you reflect on these principles, I encourage you, the listener, to consider which one or two resonate most strongly with your current situation.
Yeah, and identify a tangible, actionable step you can take in the near term.
Right. Perhaps it involves revisiting your budget with a critical eye towards potential returns on your spending, exploring diversification strategies that extend beyond traditional assets, or maybe just taking the time to thoroughly review your credit report and understand its implications.
And here's our final thought for you. Now that you have gained a deeper understanding of the essential financial education that billionaires make sure they never overlook, how will you leverage this knowledge to reshape your own financial future and truly get ahead?
What long-held assumptions about wealth building might you need to challenge?
We encourage you to continue exploring these topics, perhaps even revisiting our sources with these new perspectives firmly in mind.
Remember, acquiring this knowledge is the crucial first step, a powerful step towards building lasting wealth and securing your financial future.